Okay, so we're going to continue with that market analysis now. Given what's happening, it's all pretty dynamic, as you'd expect. Trent Primmond now joining us from Barclay Pierce Capital, who's going to take us through what he's watching. Trent, good to see you.
Good to see you. Thanks for having me.
So, well, let's look most immediately what has just happened over the past 24 hours.
Yeah.
What's your view of what's playing out and how that's informing your investment decisions?
For sure. Obviously, our view of the Ukraine-Russia conflict has been that it'll be relatively short-lived, and whether that might be days or weeks that it eventually peters out and there's an agreement from both sides. I think the most recent developments are that, and this is from the aides of the Ukrainian President Volodymyr Zelensky, is that he's agreed in principle to 3 out of the 4 demands from President Putin in Russia. Whether they can sign sort of a peace agreement over the next couple of days or whether it lasts a few weeks, I mean, that's anyone's guess. But positioning our portfolios, I think what we'll see is markets, if there is a deal signed, an agreement signed, is that markets will sort of return to how they were previously, pre-conflict, which is quite choppy markets and sell-offs. But that'll be preceded by a dead cat bounce and renewed optimism, renewed buying optimism from investors in the market. And I think that's probably a good opportunity to start trimming off some high-risk positions. I think we'll see retracements in the oil price naturally because it's run quite high short-term, and hopefully sit above the 100 US a barrel mark. More than likely, and it doesn't make sense to me, but probably shorter-term sell-offs in gold. It should be much higher than where it's at now, but we're just not seeing that. So that's our view at the moment.
Okay, so do you think that the big rally that we saw in Wall Street in Europe last night could be the start of that sort of relief rally?
I do, yeah.
Okay,
yeah.
so
I
you'd
do.
be trimming
Yeah.
now?
Yeah, for sure. I mean, look, we could see down days if talks and negotiations deteriorate. It's just a very hard market to navigate. I think any big rallies in the market right now, before something's signed, is probably, it's very optimistic. So you use those rallies to start selling out some of your higher risk positions and trimming your portfolios. Fortunately, we've sat in sort of 40% cash, which has carried us far, but it would have been nice to have some more oil exposure. But
Yeah.
Well, that's a pretty high percentage of cash you're holding right there, but obviously maybe sort of saving that obviously to see some opportunity. In terms of those high risk assets you're talking about, what are you actually trimming yourself at the moment then?
Look, some of our iron ore positions that have run quite high, I'd consider those relatively high risk at the moment. It all comes down to how much you're allocating to these names, right? And when you've got the renewables, the mining and resources sector and commodity sectors in general that you're aiming for, it's a lot of exposure to have, sort of 50-60% of your portfolio into those names. So it's really, I wouldn't necessarily call them high risk, but we have a lot of funds in those names. It's carried us far. We don't want to be too greedy. We want to take the right approach and protect the gains that we've made. So it'd be trimming off those positions, and particularly in the small cap space as well, trimming small cap exposure in particular. Why
trimming small cap exposure? Small caps are outperforming in the US.
Yeah, exactly. But I mean, from our perspective, we've held quite a bit in those names as well. So there's a lot of risk on the table for us, and managing those positions can be a bit of a nightmare. I mean, you saw the sell-off in sort of nickel mines as well more recently. I think positioning into some, Woodside, Santos, these positions are things that we'll hold, but we'll reduce some exposure because we'd see probably short-term sell-offs in the whole broader market as well, including the small cap space.
And given you are holding 30 to 40% cash, what's the trigger point as to when you do start buying and where?
Yeah, good question. It's difficult. It all depends what happens in the markets, right? Because you want to return on that cash. With rate rises coming through, we'd look at US earnings exposed companies that are domestic Aussie businesses, and we spoke about this last time on the show. Some of the Aussie banks, when markets are stable, net interest margins are going to be looking a lot healthier as rates start to rise, but you want a good read through of what's going to happen when you raise those rates. How healthy are the loan books of the banks? Are there any delinquency rates on the rise? Did people take a lot of debt out in a low interest rate environment, and how will they service that with interest rate rises coming through? So these are all factors that we sort of we look at before we enter into relatively large positions in some of those names. But my view is commodities will still be where you want to park your money. Long term, our investment thesis hasn't changed. That's what we want to invest in that market, particularly in a high inflation environment when these businesses can pass on costs to their customers. But yeah, we're obviously looking at short term falls more than likely coming through in the market, and we want to mitigate that as much as possible.